The Holy Grail of Investing by Tony Robbins. Audiobook summary. Introduction: The Journey to Financial Freedom. Tony Robbins opens by explaining that the path to financial success and freedom is achievable for everyone, regardless of background or income level. He introduces the concept of the Holy Grail of Investing, emphasizing that it lies in achieving a balance between risk and reward, developing a diversified portfolio, and focusing on long-term financial security. Robbins argues that achieving financial freedom is not just about accumulating wealth but having a strategy that works in any market condition. Key takeaway: financial freedom is attainable for everyone with the right strategies. The journey starts with understanding how to balance risk and reward. Chapter 1: The Power of Compound Interest. In this chapter, Robbins discusses the transformative power of compound interest. He explains how compounding can significantly grow wealth over time, especially when investments are made consistently. Robbins provides examples of how small, regular contributions to a portfolio can lead to exponential growth, and he urges readers to start investing as early as possible. Key takeaway: compound interest is one of the most powerful tools in wealth building. Start early and invest consistently to maximize long-term growth. Chapter 2: The Importance of Asset Allocation. Robbins introduces the concept of asset allocation and its critical role in investment success. He explains that a well-diversified portfolio can protect against market volatility and minimize risk. By spreading investments across different asset classes, such as stocks, bonds, and real estate, investors can achieve more stability and reduce the impact of losses in any one area. Key takeaway: diversification is key to minimizing risk. Proper asset allocation spreads investments across various asset classes to protect your portfolio. Chapter 3: Creating a Portfolio for All Seasons. In this chapter, Robbins discusses how to create an investment portfolio that can weather all types of market conditions, whether it's a bull market, bear market, or periods of stagnation. He introduces the idea of a balanced portfolio that includes growth-oriented investments, defensive assets, and inflation hedges. Robbins emphasizes that the most successful investors are those who can thrive regardless of economic conditions. Key takeaway: a well-rounded, balanced portfolio that includes growth, defensive, and inflation-protected assets will protect your wealth in all market conditions. Chapter 4: The Three-Bucket Strategy. Robbins explains the three-bucket strategy in this chapter, where an investor's portfolio is divided into three distinct buckets: security, growth, and dream. The security bucket is focused on preserving capital, the growth bucket is designed to maximize wealth through higher-risk investments, and the dream bucket is dedicated to fulfilling long-term personal dreams and goals. Robbins stresses the importance of finding the right balance between these buckets based on individual goals and risk tolerance. Key takeaway: use the three-bucket strategy to balance risk and reward, with each bucket serving a different purpose: security, growth, and dreams. Chapter 5: Minimizing Taxes and Fees. Robbins explains how fees, taxes, and other costs can erode investment returns over time. He advises investors to pay close attention to expense ratios, management fees, and tax implications when choosing investments. Robbins also shares strategies for minimizing taxes, such as taking advantage of tax-deferred accounts like 401(k)s and IRAs. Key takeaway: fees and taxes can significantly reduce your returns. Minimize costs by investing in low-fee funds and utilizing tax-efficient strategies. Chapter 6: Protecting Against Inflation. In this chapter, Robbins discusses the impact of inflation on investments and purchasing power. He emphasizes that inflation can slowly erode the value of your money over time. To combat this, Robbins suggests investing in assets that historically outpace inflation, such as stocks, real estate, and commodities like gold. He also stresses the importance of maintaining an inflation hedge in your portfolio. Key takeaway: inflation can erode your purchasing power. Protect against it by investing in assets like stocks, real estate, and commodities that outpace inflation. Chapter 7: The Psychology of Investing. Robbins delves into the emotional side of investing, explaining that human psychology often leads to poor investment decisions. Fear, greed, and herd mentality can cause investors to make rash choices that result in losses. Robbins provides practical strategies for overcoming emotional biases, such as focusing on long-term goals, avoiding market timing, and sticking to your investment plan during periods of volatility. Key takeaway: emotional decisions often lead to poor investment outcomes. Stay disciplined, focus on long-term goals, and avoid reacting to short-term market movements. Chapter 8: Finding a Fiduciary Advisor. Robbins stresses the importance of working with a fiduciary financial advisor, someone who is legally obligated to act in your best interest. He warns readers to be cautious of advisors who earn commissions based on selling products, as they may not prioritize the client's best interest. Robbins also shares tips on how to vet and choose a trustworthy advisor who can help you reach your financial goals. Key takeaway: work with a fiduciary advisor who is obligated to act in your best interest. Avoid advisors who prioritize their commissions over your financial success. Chapter 9: The Power of Dollar Cost Averaging. In this chapter, Robbins explains the strategy of dollar cost averaging, where investors contribute a fixed amount of money at regular intervals, regardless of market conditions. This approach allows investors to buy more shares when prices are low and fewer when prices are high, ultimately reducing the average cost per share over time. Robbins highlights how dollar cost averaging can smooth out market volatility and increase long-term returns. Key takeaway: dollar cost averaging helps reduce risk by spreading out investments over time, buying more shares when prices are low and fewer when they are high. Chapter 10: Understanding Risk Tolerance. Robbins introduces the concept of risk tolerance, which refers to the amount of risk an investor is willing to take on. He emphasizes that understanding your risk tolerance is crucial in designing an investment strategy that aligns with your financial goals and emotional comfort. Robbins suggests that investors assess their risk tolerance based on their age, financial goals, and time horizon, and adjust their portfolios accordingly. Key takeaway: understand your risk tolerance to create a portfolio that aligns with your financial goals and comfort level with market fluctuations. Chapter 11: The Role of Index Funds. Robbins explains why index funds are a powerful investment tool for most investors. He argues that low-cost, passive index funds consistently outperform the majority of actively managed funds due to their low fees and broad market exposure. Robbins recommends that investors consider allocating a significant portion of their portfolios to index funds to achieve long-term market returns with minimal effort. Key takeaway: index funds are a low-cost, passive way to achieve market returns. They outperform most actively managed funds and should be a core component of your portfolio. Chapter 12: Mastering Asset Rebalancing. Robbins discusses the importance of regularly rebalancing your portfolio to maintain your desired asset allocation. Over time, market fluctuations can cause your portfolio to drift from its original allocation, which may increase risk or reduce returns. Robbins provides practical advice on how and when to rebalance your portfolio to ensure it stays aligned with your long-term goals. Key takeaway: regularly rebalance your portfolio to maintain your desired asset allocation and minimize risk over time. Chapter 13: The Importance of Patience. In this chapter, Robbins emphasizes that one of the most critical traits of successful investors is patience. He argues that wealth is built over time, not overnight, and that sticking to your investment plan during both good and bad times is essential for long-term success. Robbins encourages readers to adopt a long-term perspective and avoid the temptation to react to short-term market fluctuations. Key takeaway: patience is key to investment success. Stick to your plan and maintain a long-term perspective, even during periods of market volatility. Conclusion: achieving financial freedom. Robbins wraps up the book by summarizing the key principles of investing: diversification, long-term planning, asset allocation, and emotional discipline. He reiterates that achieving financial freedom is possible for everyone if they follow these principles and stay committed to their financial goals. Robbins encourages readers to take control of their financial future by applying the strategies in the book and seeking out continuous education. Key takeaway: financial freedom is within reach if you apply the right principles and remain disciplined. Stay committed to your goals and continually educate yourself on best practices in investing. Final thoughts. The Holy Grail of Investing by Tony Robbins offers a comprehensive guide to building long-term wealth through smart investing. Robbins emphasizes that financial success comes from a combination of strategic asset allocation, minimizing costs, understanding risk, and maintaining emotional discipline. He encourages readers to focus on long-term financial freedom by following a balanced approach, practicing patience, and making informed decisions about their investments. We recommend you read this book. Do not forget to subscribe to Zillion Pro for more quick summary audiobooks.